Eric Muathe. In this video, we are going to be taking a look at the most opportune time to sell a stock or to go short. And we are talking about an opportunity where when the stock is just about to crash, you want to be a seller or you want to be able to short the stock so you can get the most out of that move. So first and foremost, before you can understand this method, I encourage you first and foremost to go to YouTube and search for the Ultimate Muathe breakout. This is actually inverse the Ultimate Muathe breakout. So just take this method here and turn it around, and it's gonna give you the ultimate short period in a stock or in a market. So it's just the opposite. So I encourage you first and foremost, before you watch this video, you have to understand this series of videos here, or at least you have to understand that the minimum requirements are just being flipped around, and now we are using the same principle but now to find short ideas. And what you need to do is find stocks. Here we are looking at monthly charts. So all these examples, this setup here is going to be talking about monthly charts. I know most people don't use monthly charts, but they're very important. So the minimum requirements are very, very simple. There are only two things that you need. Number one, you want the stock's monthly RSI to be making a 3-year low. That's very simple. Second, you want one of the MACDs, and I use two settings. I use either this one here or the main MACD default. So you can either use the default MACD setting or add another MACD setting, which is the 583. Okay, so one of these MACDs has to be making a 3-year low. So if you have the monthly RSI moving to 3-year lows, and you also have one of the MACDs moving to 3-year lows, that gives you the opportune signal and the opportune setup to short or to sell a stock. So without further ado, let's go to the examples so that this can be crystallized in terms of actual market action that has taken place over the last many years. But before we go to the examples, the most important thing is this requirement here. This is the most important. In fact, most of the time you don't even have to look at the MACD requirement. The most important setup here is that your monthly RSI moves to 3-year lows. That is the most important requirement. This is just for confirmation, but you can use this by itself and the method is going to work wonders for you. So let's go to the examples, and we begin by taking a look at RAX. So you can see here, after making highs beginning of 2013, at some point in February of that year, it made a fresh move to 3-year lows on the MACD. Okay, and this is after it had a nice run. You're talking about lows here in 09 of about $5 all the way to $80. So the stock had a nice run. Okay, before I do that, notice that all this nice run prior here, like for example during this breakout, was actually meeting the minimum requirements for the ultimate Muathe breakout. Now we are looking for the ultimate sell signal, and you can see that it is now, we are not making all-time highs, we are actually making all-time lows on the monthly MACD, which makes this a short idea by itself. So we are looking at a stock price here of about 55, and at that time you can see that the MACDs, none of the MACDs were moving to 3-year lows. So none of the MACDs were at 3-year lows. So it does not meet the complete minimum requirement. But remember, we are saying only the RSI has to give us the sell signal and we can take that trade. So this is at $55. We are making a 3-year low, all-time lows on the monthly RSI. So let's go to what happened after that. And you can see, so we are previously talking about this break there. Price was about $55, the break, and the price was about $55. You can see as of right now the stock went on to trade as low as $35 before bouncing back, and since then it still continued to make lower lows. And so you can see that ever since you got the move to 3-year lows, which was here, the stock has generally been down since then. Makes for a nice time to sell, nice time to short. Let's go to the next example, and here we're looking at a stock, CCG, just a random stock, made fresh move to 3-year lows, all-time lows on the monthly RSI, moving below the previous monthly closing low. So you can use the previous and the most recent monthly closing low here as your trigger point, and once you move below that in price and you move below to 3-year lows, all-time RSI lows, then you know that the stock is a short. And so you just take a look at the MACDs, and again, even here you can see none of them was making 3-year lows. So confirmation on the MACD was not yet confirmed, but the RSI was confirming that the stock was looking bearish. So you can see here what happened since then. Stock's down, so the ideal sell point, ideal short point being discussed was here, which was this break. And since then you can see that from about $9.20, stock still continues dropping here, going under $7 as of right now. Also, don't forget that as of right now it is moving to fresh RSI monthly lows, so even right now it is breaking down again. Anybody who can short this over time, you'd expect it to be moving lower. Recently broke below the previous monthly closing low there. Let's take a look at the MACDs, and you can see now the MACDs are already trading at 3-year lows already. That was already confirmed. Another move to 3-year lows on the MACD, and we are also trading at 3-year lows on the MACD. After breaking down here, we are still below that line. So the MACDs were moving below 3-year lows, all-time lows, which is the reason why the stock is experiencing this drop. Let's go on to the next one. Now let's take a look at ANF, and here we are seeing that the RSI moves to fresh 3-year lows sometime in 2008, and the price there was at about $60. So that's a sell signal, short signal, and you can also see that the MACDs in this example look like they are primed to make fresh lows right there and also right there. So the MACD requirement to me is met here and also here. So let's see what happens after this. And you can see now that makes a lot of sense, because the break was here in the 60s. Stock would go on to trade as low as $5, or because it broke to fresh lows on the monthly RSI. So the ideal time to sell the stock was somewhere here, or short the stock somewhere here. You would have been either out of the stock, or you would have been short the stock for a very nice gain over the next couple of months. Take a look at another one here, EPM, just a random stock. You can see here sometime in 2014 it makes a fresh low in terms of the RSI, and also we see that the MACD, at least one of the MACDs, was moving below 0, which is a sign of weakness, and also very close, if not in the process of making fresh 3-year lows on the MACD. So here was a stock trading at a price of about $10.70 before breaking this line here, which was the monthly RSI. So that's a sell signal, short signal. Let's see what happens since then. You can see even here in the current market it continues dropping because it's now below the line there. So this was a short signal there, and since then the stock has moved just now touching around the $9 and continues over time. Remember, these are monthly charts. Over time we are going to see this one also potentially see lower prices. As of right now, you see that momentum to the downside is being confirmed by now the MACD being below zero, making 3-year lows, and also the main MACD has already now eclipsed the previous low, and so momentum continues being to the downside. We might explain why it continues trending lower. Let's take a look at JCPenney. I just want to show you how this all plays out here. JCPenney at some point in July of 2007 looked like it was finding support on this lows line. Now this lows line had held here for a nice entry. It also held here for a nice entry and looked like it was going to do the same thing here. This is now sometime in middle of 2007 July. Okay, but now let's move on. You can see here now I'm showing a chart showing you end of July, about 2 weeks later, and now it is down and it is now not finding support. So there's no support. It's now breaking down to 3-year lows. That RSI signal to 3-year lows is a sell signal. Let's see whether we get confirmation from the monthly MACD, and you can see yes, the monthly MACD here was also breaking down or had already broken down to 3-year lows. So that's a major sell signal being confirmed by the MACD. And so let's see what happened after this price trading here at about $61. You see that since then, from this price range here, and also because of the break, the stock would go on to trade from 60s all the way to as low as $30, $29, just because we observed this break to 3-year lows, and also which was confirmed by the MACD making 3-year lows and also moving below zero, 3-year lows. So two things were going on in the MACD there, hence the reason why the stock was down a huge chunk, and you would have been out of the stock if you knew the 3-year lows principle, or you would have been short the stock given the fact that it was breaking down on the MACDs and on the RSI. Take a look at JCPenney fast forward, and now we are trading in middle of 2012. Again, the stock makes another move very close to 3-year lows here. So if it breaks below this level here, it could be a short. Previously this level had held and the stock had seen a nice move higher. So you know you're either going to get a bounce here or a break. If you're long the stock, you're a little bit nervous because you know if it breaks below that, that's not going to be good. And also you'd be nervous because if you take a look at the MACDs at the time, you can see that one of the MACDs was already at 3-year lows. So that's really not what you want to see. This 3-year lows move was not good, and the monthly RSI looked like it was just about to break to 3-year lows. So let's take a look at what happened after that. And you can see that since then, which was this period here, the stock would go on to trade from the lower 20s all the way to $5, just because it broke down to 3-year lows at this point here, or you can even use the subsequent move to 3-year lows here as another signal that the stock was weakening and needed to be sold. You can see here that the minimum requirements does put you in the right direction of that trade. Let's move on here. Now we're taking a look at the Argentina stock market index, and you can see here at some point in 2007 was breaking out. Everything was good, looked good. The RSI was back above 69.10, so everything looked good. But you always have to be aware that a market can change direction, and of course in this particular instant you just draw a line here. You know that if you ever break below this line, which responds to the 3-year lows, you want to be a seller. Let's fast forward from October 2007, and you can see now we are turning around, and this is end of November 2007. Still we haven't broken down to 3-year lows. Nothing to worry yet. Fast forward, and now things don't look the same, because now you're moving to 3-year lows on the monthly RSI. That's not a good sign. And also at the same time, to confirm that something was developing, you can see that the MACDs, one of them was about to make a move to 3-year lows and also move below zero. 3-year lows and moving below zero is not a good sign of momentum, and the main MACD was also getting very close to breaking to 3-year lows. So you gotta be careful here. Remember, most of these charts that I'm showing you are data showing 3 years worth of data, because we are looking for 3-year lows. So you got RSI looking like it wants to break, and also the MACD is looking like they're about to break. That's something to keep anybody who was holding long there to be a little bit concerned. So since then, we know that the entire world market was down, which makes sense, because after breaking the lows there, and also the same line became resistance. I have to point that out. So you broke down here, extend that line, this also becomes resistance, and you have double top resistance. That's a major red signal or sell signal there. So from a price range, we are talking about 2,100, we would go on to trade as low as 800. Big drop. So there was a subsequent sell signal, another one here, when you made another move to fresh lows on the 3-year time frame, which was somewhere around here. So multiple signals to sell, and of course the MACDs were also confirming that there was a break to 3-year lows during all that period. There was a break there and a push to 3-year lows, and also you can see that there was a break of the main MACD moving to 3-year lows. So that market collapsing in 2008 made a lot of sense, because it met our minimum requirements on the RSI and on the MACD. Let's move on. Take a look at Bank of America, and here we are showing time frame in November 2007. Of course, there's a break there to 3-year lows on the monthly RSI. Price there is at about $41 at the end of that month. And if you take a look at the MACDs, things were looking very bearish, because the main MACD was at 3-year lows, which is not good, and also the other secondary MACD was already trading at 3-year lows and also trading below zero. So 3-year lows here and also trading below zero. Also, one thing I have to note, if you've watched my videos on the MACD, take a look at this uniform action 2-0 and back below it. Uniform action 2-0 and back below it tends to be a sell signal on the MACD. So lots of things here. Indication here was at $41, the stock was looking very bearish. So you fast forward, and of course we know that from about this range here, which is where we got the sell signal, the stock would go on to trade as low as $2.50. And so the break took place there. There was another break here to fresh 3-year lows, which was this drop here, massive drop. So lots of things were going on. Ultimately, it is the fact that the stock broke down to 3-year lows, some point here and here. That was a red flag. Also, there's a move to all-time lows. Take a look at this move to all-time lows. So if you go back and draw a straight line, you see that there was a break to all-time RSI lows there, which is a major red flag, which is this sell point there in price. And then this also becomes resistance, because you can see that you went above the line and back below it with uniform action. And if you've watched my videos on uniformity, you know that this here is a red flag also. Happens to be this bounce here at about $32, another red flag and a reason to sell the stock, and that's why it was down significantly since then. Take a look at ROVI. The stock had a nice run sometime here in '99 from about $5 all the way to about $100. Very nice run. But now we are looking at the other side of the trade, and it's very close to breaking to all-time lows, also to 3-year lows. All-time lows on the RSI, 3-year lows on the RSI is a red flag. We all know that by now. And even though the MACDs are not giving us fresh move to 3-year lows, all-time lows, the RSI, which is the main indicator here, was telling us that a move to 3-year lows, all-time lows, would be destructive. Here we're talking at a price range of about $70. Let's see what happened after that. And you can see that the stock, so we had broken down to 3-year lows there. So draw a straight line like that. And so the price range here was at about 70. The stock would go on to trade as low as $10. Okay, just because it broke down right there. So let's go to the next chart. And so now we see that it is still showing the same chart here, where by 2002 the stock actually had continued dropping, because there's another move right there in July to 3-year lows, all-time lows, which was at that price of $50. Stock still went down to $10. There's also another break to 3-year lows somewhere here in 2002, which is what moves it from about $25 again all the way to $10. So all these subsequent moves to 3-year lows on the monthly RSI is another indication of weakness and a reason to sell or short the stock. Now let's take a look at BlackBerry here in 2001. So you are making a fresh low in terms of the monthly RSI right there, and that's not a good sign. So at $10 you're breaking down, and it looks like if you break below and hold below that line on the monthly RSI, then this is a destructive chart. And one thing you would have done is set a stop or an alert with a break at this point. So if it breaks below the recent monthly closing low, which was at somewhere here at $11, a break of that $11 price would be red flag. And also you see that the RSI is moving to all-time lows here and a move to 3-year low. At the same time, the MACD was just about to break right there, and the MACD was about to break to A, below 0, and 2, to 3-year lows, all-time lows on the MACD. So you got the RSI showing potential to break down, and also the MACD showing potential to move below 0 and actually also break down to 3-year lows. So let's see what happened after that. And you can see the stock would go on to trade from this price range of this break point there, which was at about $10. It would go on to trade as low as under $2. Let's take a look at, again, BlackBerry. And now we are coming to the 2011 time period. You're just about to make a 3-year lows move here in price. Stock is breaking down below $40, breaking down below the previous monthly closing low as a trigger point to short, or about $44. So you got RSI breakdown, price breakdown, and you can see here that the MACD, the main MACD, was also moving to fresh all-time lows on the MACD. Fresh all-time lows, which is not good. And also notice here that you got this uniform activity above 0, back below it. Uniform activity above 0, back below it. Uniform activity above 0, back below it. So you had also another sell signal coming from this resistance at the 0 line on the MACD, and those levels were actually corresponding with this high and this high and this high. So the MACD interpretation also gave you sell points at these highs, but for the purpose of this video we are looking at a break to 3-year lows on the RSI as a sell signal. And you see, since then, after breaking down here to 3-year lows, let me draw that, breaking down to 3-year lows, which was at $40 or so, the stock would go on to trade as low as $8, $9. Let's take a look at Japan here, and this is now in 1990 February, and it needs to hold this level, otherwise it could drop. After having a nice run in the late 80s, this is the line investor needed to watch. So below that, you'd be making move to 3-year lows, and that was a price range of 35,000, and you can see that the MACDs are also threatening to move to 3-year lows. So that's a thing you needed to watch for: MACD action and the RSI action, early 1990. So now let's go on to the next chart, see what happened after that. And you can see now, by the time we move to March of 1990, the monthly has already broken down to 3-year lows. This is a major red flag right there, as the monthly RSI moved to 3-year lows. And as of right that point, you can see that the MACD had moved to 3-year lows and also was moving below zero. Also, the main MACD was now also getting very close to moving to 3-year lows. But since one of the MACDs was at 3-year lows right there, that shows that this was a very serious time to short the market in Japan or sell. See what happened after that, and you can see, so from the period here in 1990, which was there, the market would go on to move from about 34,000 all the way to the lows in 1992 of 14,000. That's a major drop in a market, all because of observation of this break point right there. There was another move to fresh 3-year lows here with this move middle of 1990, which was this break point, which also was a serious sell signal and also a reason why the market was down after that. All right, let's take a look at the Japanese market. After that, you can see there was also another move to 3-year lows here, which was some point in 2001, broke below that, and that was a price range of about 12,000, and it would go on to trade as low as 8,000 by 2003. Sticking with the Japanese market, we are looking here now in 2007, and we are making a move to 3-year lows in 2007 November. That's a serious sell signal, and don't forget that we are also moving below 50 on the monthly RSI. Let's take a look at what the MACDs were doing at that time, and you can see that, man, that was a serious sell signal, because one of the MACDs was already trading at 3-year lows and was also pushing below zero. Lots of reasons to be concerned in late 2007, and obviously we know that the market did go down in 2008, so that RSI protected you from this level here to get short or sell the market, which was at about 16,000. The Japanese market would go on to trade as low as 7,000. Serious break. There was also another break to 3-year lows somewhere here, which was during this break from about 11,000 all the way in the same month all the way to 7,000, because you broke support. You broke support on the monthly right there. So another sell signal. And so if you sold or went short during this month here, you knew that prices would really drop from about 11,000 all the way to as low as 7,000 because of this break point back to 3-year lows on the monthly RSI. Alright, so I just want to show you the flip side of this. Remember, the ultimate Muathe breakout gives you the buy signal on the way up, and the ultimate sell signal is on the way down, but the principles are the same. So I want to show you what happens. You can see here now, sticking with the Japanese market, moving to 3-year highs on the monthly RSI. At some point here was 9,800, and this was a time of December of 2012. So we are seeing the opposite action. This thing works on the way up and on the way down. So you make a 3-year high move on the monthly RSI, which is good, which is a buy signal. And also you can see that you want one of your MACDs to make a 3-year high there, which is this entry level there. And also you can see a move back above 0 and the possibility of breaking out either that way or breaking out to 3-year highs. But in this particular example, we see that one of the MACDs was trading at 3-year highs, which is one of our requirements for the ultimate Muathe breakout. So ditto to that. Looks good. And more importantly, the monthly RSI was looking like it was moving to 3-year highs. So December 2012 looked like the Japanese market was going to be back in full force, and let's see what happened after that. It makes a lot of sense that since then you had this magnificent jump in share prices from about 9,800 all the way to 16,000, just because of this slight observation that the RSI was moving to 3-year highs. A very powerful setup, very powerful. And also you can see here that at the time, late 2012, the MACDs were not disappointing because the MACDs broke out there and the other MACD had already broken out. So the ultimate Muathe breakout works on the way up, and it also works on the way down if you're looking for short opportunities. Let's take a look at gold. Now this is gold price in 1996. Okay, you can see here a move to 3-year lows on the monthly RSI, which is bearish, and also you're breaking below the previous monthly closing low in price. So two things happening there, not good. And take a look at the MACDs, and you can see one of the MACDs, if not both of them, were already trading at 3-year lows. So that's very bearish. And also 3-year lows here, and also moving below 0 and finding resistance at 0 is not a good sign. So in 1996 September, gold was looking very bearish. Price range there was at 330, if you can believe that. Let's move on to the next chart, and you can see that from this price range during this break right there, which corresponds with this previous signal that we were talking about from the previous chart, the stock would go on, or the market would go on, trading from this level here in the 300s all the way to about 280, which is a big percentage drop because it observed the ultimate Muathe sell signal. Let's take a look at gold again here. After this nice run, and actually if you go back and check this run in gold, you'll see that it met the ultimate Muathe breakout, hence the nice run up. But you can see here now at some point in end of 2011 December here that the index is just about to make 3-year lows, if not trading at 3-year lows in terms of the monthly RSI. Let's take a look at what was going on here in terms of the MACD, and you see that one of the MACDs was just about to move to 3-year lows. I mean, as close as it gets. So gold in late 2011 was looking bearish. Also, you are moving below the previous monthly closing low there at about 1625, somewhere around there. Okay, but the main thing here to watch for is this move to 3-year lows in terms of the gold price. That's a major sell signal. Let's see what happens after that at 1600. Also, you can see that this is continuation here. And it's important to note in this particular example, unlike most of the examples in this video, that was the break point there. All right. which was this time period, but gold did not go down. So at this particular point, you could have had to be stopped out of your short position. Okay, but notice what happens, because I think it's important to understand how this played out. So there was a break there, extend the same line, and you can see the same line becomes resistance on the monthly RSI. So there's a sell signal there, which is this price range at about 1750. Again, in the same year of 2012, it comes back to the same level there, and you find resistance this time at about 1800. So even though it did not move lower, the same line, which was support or breakpoint, became resistance. This is something to keep in mind, because not all setups are gonna work out. So this one didn't work out. I need to point, this one did not drop immediately. But actually what happened is, now we had the line itself, which was a breakpoint, becoming resistance for the entire 2012 trade. But yet we can still use our method, because now you come back and make a fresh 3-year low at the beginning of 2013, which is something that I recognized at the time. So beginning of 2013, we went short gold because it broke down here to 3-year lows. That's a serious break, also very close to moving below 50. We take a look at how the MACDs were setting up, and it was very obvious to me at the time that this was a serious sell signal for gold right here. Also take note of this uniform activity above 0 and back below 0 on the MACD, which is bearish. Also the main MACD was ever so close to moving to 3-year lows, if not at 3-year lows. So gold, beginning of 2013, was giving a major sell signal, and that's why we went short gold early on in 2013. Let's see what happened since then, and you can see that you had a major drop. So from the break point there, which happens to be this period right there at about 1600, gold would go on to trade as low as 1200, just because you observe that break in the monthly RSI. Also, you can see on this chart here, there was another break during this slight break there, because gold did try to move for 1 month somewhere here, and then subsequently fell again. So there was another sell signal sometime in early 2012 during this break point there. So the move to 3-year lows was your signal that gold itself was actually struggling beginning of 2013. So let's go on here, and actually I guess that's the conclusion for the video. And yes, what we are looking at here, let me bring back the gold chart, is so in this particular instant, if you want the ideal sell point for gold, it has to be when it moves to 3-year lows, which is not what is happening right now. So if you use that principle that the RSI has to be moving to 3-year lows, the MACD has to be at 3-year lows, you can see right now gold is not a short. Otherwise, this video was trying to educate all of us that the best time to sell a stock or to short a stock is when the monthly RSI moves to 3-year lows. That's a must-have requirement, and also you need confirmation that the monthly MACD also gives you a 3-year low, and one of the MACDs should do that. Okay, so but the main requirement for the ultimate sell signal is when the monthly chart gives you and shows you that the RSI is moving A to all-time lows, or B to 3-year lows on the monthly chart. Eric Muathe, good luck, peace, and blessings. Mwah!